everyone. This is our Finance 452 project. It's going to be by myself, Courtney Days, Reed Jones, Brittany Meek, and Amelia Varela.
From the information we were given, it was concluded that the portfolio had a yearly return of 16.38%. We compared that to the yearly return of three benchmarks, the S&P 500, the Russell 2000, and Dow Jones Industrial. As you can see, the portfolio did very well overall compared to these benchmarks, with only underperforming in comparison to the Russell 2000. Slide. We chose to put our updated portfolio on the Efficient Frontier via Bloomberg, as you can see. Judging from the Efficient Frontier, we chose Portfolio 2 when deciding how to weigh each stock, as it gives us the highest return per unit of risk at 50.15%. Slide.
After a lot of research on our portfolio, we decided that we wanted to sell 4 different stocks in order to maintain the highest return on the Efficient Frontier. I'm going to go into detail of each of the 4 companies we chose and why we chose those companies. The first company we chose is 3M Company. While 3M had an above average ROA and current ratio, their projected growth rate was less than 1%. After researching, we discovered that 3M is staring at a potentially significant liability under several lawsuits for its involvement in the PFAS contamination issue. A Forbes article attributes 3M's underperformance to investor concerns over lawsuits surrounding the environmental issues related to manufacturing plants, as well as for product safety. The article goes on to say that most of the decline of the last 3 years is attributed to a contraction of the company's PE multiple. The PE multiple in 2018 was 24, and by 2020 it had gone down to 18. Considering the market does not like uncertainty and the high risk that they are facing, 3M is our number 1 least favorite stock. Their enterprise value and enterprise value EBITDA ratio has declined significantly over the past 4 years. Their weighted average cost of capital has also increased significantly in the last year. The Sharpe, Traynor, and Jensen alpha ratios were looked at before we made a decision. We also took into consideration their dividends per share, their dividend payout ratio, and their cash flows. As of December 2020, 3M had only had a gain of $384 to our portfolio. The portfolio holds about 480 shares of 3M, and I recommend that we sell all of the shares we have with this company.
For the next stock that we decided that we want to sell is Tyson Foods Incorporated. Tyson's Food had a below average quick ratio and ROE. They also had a projected growth rate that was below 1% at a 0.8%, which is only 0.3 more than 3M's. Research showed that their low ratios are due to an oversupply in the chicken industry. Tyson has also recently been involved in some unsafe workplace media reports. Tyson's enterprise value has declined exponentially over the past year. We also took into consideration things like the dividend payout ratio, free cash flows, and the weighted average cost of capital. We also looked at the Sharpe, Treynor, and Jensen's alpha ratios. We have 1,200 shares in Tyson. I and my group recommend that we don't sell all of them. However, we think that we should sell about half and keep around 600 shares. With our new portfolio, the Tyson shares will now make up about 2.32% of the portfolio.
The next stock that we want to sell is Cisco Systems. Cisco had bad ratios all around. Their quick ratio, their current ratio, and their ROE were all below average. Their projected growth rate was low, coming in at 11%. With the low projected growth and their unpromising ratios, they are our third least favorite. And it brings up a concern if they will be able to keep up with their short-term obligations in the coming years. Cisco's enterprise value declined by about 21% from 2019 to 2020. We also took into consideration things like their free cash flow, dividends per share, dividend payout ratio, and even their weighted average cost of capital. I recommend that we sell all 400 shares in Cisco.
The next one that we decided that we need to sell is Pfizer Inc. When reviewing this stock, we learned that it recently combined two of its businesses and created Viatris, which is another one of the stocks that we studied in our portfolio. Viatris had a below average ROE and ROA. However, it had a large projected growth rate of 37%, the highest of any of the companies in the portfolio. Pfizer also had a low ROA and a mediocre growth of 17%. Based on our research, investors that owned Pfizer shares prior to the close of the deal now also own roughly 0.12 of shares in Viatris for every 1 share of Pfizer common stock held. Thus, we chose Pfizer as our fourth least favorite. Their enterprise value has continuously decreased over the past 4 years. Their free cash flows have also decreased a great deal over the past few years. Their weighted average cost of capital, dividend ratios, and free cash flows were also taken into consideration by our group. The portfolio holds 1,475 shares of Pfizer, and I recommend that we sell 500 shares, leaving us with 975 shares of Pfizer. With our new portfolio, Pfizer will now make up about 2.07% of the weight of the portfolio.
When it came to purchasing shares, we wanted to stay in some of the same industries that we were before, like food, energy, tech, and electronics.
Some of the stocks that we decided to purchase were Amtech Inc., General Mills Inc., Hewlett Packard Enterprise Company, NVIDIA Corporation, and Global X Lithium and Battery Tech. The first stock that we decided to buy was Amtech Inc. Amtech has actually recently acquired NSI-MI Technologies to be a part of its electronic instrument group. We recommend that we buy 500 shares of this stock. This would make up 3.95% of our portfolio. Some indicators that we considered were weighted average cost of capital, return on equity, and the dividend payout ratio.
The second company we decided to purchase was General Mills Incorporated. We really wanted to focus, we really looked at the key indicators as far as the quarterly dividend payouts. They have been consistent over the last 3 years, paying out dividends quarterly, and their dividend payout ratio. We recommend that we buy 1,000 shares of stock for this company, and this would then make up 3.59% of our portfolio.
The next company that we decided to purchase was Hewlett Packard Company. They actually have new cloud data services that will be available with HPE GreenLake, the industry's first and leading cloud on the premises. Innovation introduced with data services in the platform include new data service cloud consoles, cloud data services, and HPE Alletra, new cloud native data infrastructure. We recommend that we buy 1,500 shares of stock for this company. This would make up 1.38% of the portfolio. Also, other indicators that we considered were the earnings before interest, taxes, depreciation, and amortization, which actually increased.
NVIDIA was another company we decided to purchase. It was a lot of key indicators that we really liked about the company that showed a lot of short term and also long term growth. The major indicator was the income statement and the balance sheet. We looked at the revenue, we looked at the revenue share, the total debt to equity, which was 4.569%, and the current ratio, which was 4.09%. And so basically, what is that telling us is that the company is able to pay their bills because of the revenue that they have coming in, but also has a lot of financial leverage and profitability margins. We recommend that we buy 75 shares of the stock from this company, and this would make up 2.52% of our portfolio. The last company we decided to invest in is the Global X Lithium and Battery Tech. This is also known as LIT. LIT showed profit margin. The PE ratio was 38.6%, which again shows the market value measures and the profitability measures. We recommend that we buy 1,000 shares of stock for this company, and this would then make up 3.66% of the portfolio. Even though this company was in a different industry, we looked at some of the trends in the economic indicators that were showing that a lot of companies are moving towards electronic vehicles. And so we decided to definitely be a part of that by partaking in the battery that a lot of companies like Tesla, and I know Apple is definitely coming out. They announced December 2020 that they're coming out with the first fully electric vehicle.
With our updates, the portfolio will now have $11,318.54 in cash and $1,709,728.46 in stocks. Thank you for your consideration.